Hey guys, welcome back to another video. So today we're going to be talking about private company valuation mistakes that buyers and sellers make when they're thinking about selling their business to, private investors, private equity, or a competitor down the street. And so just as a quick background, I have another two-part video series that's focused more on how to value private businesses, going through the qualitative and quantitative drivers, really talking through some case studies in the part two of that series. And really there was really a lot of good positive feedback from, the viewers, and really appreciate your support there. And so I thought, what would be really good is to kind of continue that and talk a little bit more about some of the mistakes that I've seen people make when they're trying to value a business, or things that are oftentimes overlooked when you're not in it day to day, and also talk more about some case studies. So this is going to be overloaded with a lot of different examples that, from my day-to-day business and real life examples that we can talk about. So if you really like that and that's your learning format, hopefully you'll really enjoy this video. And then just as a quick background, so, my day-to-day business, I focus mostly on selling lower mid-market businesses in Canada. So I'm based in Toronto, Robley Capital, and we focus on businesses that are worth anywhere from $1 million up to about $50 million in enterprise value. So, we do 10 to 12 transactions a year. And so I come across oftentimes clients that are thinking about selling and, have received a valuation from a CBV or someone else. And, I can kind of pick and choose and see, if it's a good valuation or not, just by seeing if some of these considerations are being reflected in those reports. So let's just jump into it. So oftentimes, whether you're a seller or a buyer, you're going to have a lot of different opinions from, the bankers, the investors, lawyers, your family members, or, mentors on how to value a business. And there's no real correct way, but, traditionally there is a very common approach, which is the EBITDA multiple approach, where you're really multiplying EBITDA, the adjusted profitability of a business, by a multiple of that profit. And, when you're doing that, though, that's a really kind of almost like a generalization of the approach, but there's a lot of specific variables to valuation that sometimes people just overlook because either they don't know, or especially if you're a seller, you've never really gone through this process before. And so this video is going to be segmented into two parts. Part one is this, and then there's going to be a second part two as well posted to the channel. And so I'm going to be talking about 3 mistakes in this one and then another 4 down here. And you can see right here, so the first video, we're really going to be talking more about pricing off future growth, pricing off of historical earnings and, ramp up in historical earnings. And then also talking about some, invisible costs that would impact the true adjusted cash flow for an investor. And then in the second part, it's going to be more focused on balance sheet related items. So net working capital, cash-free, debt-free closings, enterprise versus book value. So we'll really get into it. But I think what's really good with this video is that I'm going to be really using a lot of real life examples to try to translate these messages. So as I already kind of referenced earlier, really the common approach in lower mid-market private business valuation is not a discounted cash flow model or an income capitalization method. In most instances, if you're selling a business and using either a broker or an investment banker, such as our firm, we're going to price your business typically off of a multiple. Sometimes it's revenue, but I would say in 80-90% of the time, it's going to be EBITDA. And that's earnings before interest, tax, depreciation, amortization. And also you adjust that for any personal expenses or, kind of discretionary expenses that would be run through the business to truly reflect under a new owner, what is the true cash flow of that business? And then you take that EBITDA and then you apply a valuation multiplier. So for example, if your EBITDA was $500,000, you apply a multiplier of 4, then really your enterprise value, the value of your business would be $2 million. And that multiplier, and I talked about this in the earlier video, is really influenced by the quality of your business, the quality of the buyers, the marketing process, how good your advisor is that's representing you. So a lot of different things. But ultimately, that's going to be the key negotiation point when you're going to market. But as well, outside of that, professional buyers are going to be keeping a lookout for what your real EBITDA is, some of the balance sheet considerations. And that's really what this is more focused on. Not just a simple general rule of thumb of saying profit times a multiple, but let's dig into it and really understand it. And so, when I first talk about really what your business is worth. And I didn't talk about this in the last video, but I really want to kind of highlight this here. Terms always influence your price. So if you're going to market or you're a buyer and you're thinking about buying a business, ultimately the value of that business, it's not really one number. it's really a range, and it could be the bottom end to the top end, depending on the terms that are available to purchase that business. Every seller is going to have different expectations around how much cash they want, how much seller financing they're willing to offer. Maybe they're interested in rolling some equity and staying on as a minority partner to transition that business. So each payment term influences the range of that value, either higher or lower, or sometimes case by case. So when you're thinking about business valuation, if you're the seller, the reality is it depends. Yes, it could be a multiplier of 5, but if you're willing to hold back a significant note or reinvest in the equity box, it could be 5.5, because all of a sudden you've offered more favorable terms to the buyer pool, expanding the number of buyers that could potentially be interested in your business, and also reducing their transition risk, which influences the multiple higher. And the reverse is, say, for example, you wanted a lot of cash. Well, if you want a clean, quick exit, no strings attached, well, from the buyer's perspective, that's a lot more risky. Now the transition risk is a lot higher because you could just go off into the wind and take the cash and not stay committed to transitioning that business. So if you want a large percentage of cash down or only a cash offer, then probably your valuation range is going to be lower. And so that's why I kind of put this table together here to say, here are the common payment terms. Cash is, just cash. A holdback is when you hold back a portion of the purchase price, maybe for 12 to 24 months, typically to, transition working capital and any kind of, other representations and warranties that you made as a seller. A vendor note is a loan between you as a seller to the buyer to help finance the buyer. An earnout is when you accept future performance will dictate the amount that you're paid, right? Seller equity, rolled equity is when you essentially hold back equity in your business. And then purchaser's own equity is instead of holding equity only in your business, you're taking equity in the purchaser's business or combined entities of the purchaser and your business once they're merged. So, based on these payment types, the lower the skin in the game for the seller and the higher the resulting transition risk. Typically, it's the bottom end of the range. So, for example, cash. But on the flip side, if you're open to staying committed to the deal longer, really being aligned, maybe holding equity, for example, or sharing in the risk of future performance by taking an earnout, all of a sudden you're pushing your value to the higher end of that range. So this is really important when you're thinking about it. And sometimes, you go and you get a report from a CBV and they give you a number or they give you a rough range. But what is that range dependent on? You as a seller or you as a buyer, if you're in a process, you really need to ask yourself and understand the rules of the sandbox. What are you guys really negotiating over? Is this a cash type deal? Is there significant vendor financing available? Because your thinking should change based on the terms available to you when it comes to valuation. Okay, so let's jump into the first mistake. And so I've seen this, I would say right now, I'm in 2022, the end of 2022, and, just coming out of COVID, there's been this huge ramp up in performance for a lot of different distribution, manufacturing businesses. A lot of pent up demand has happened. And so what's ended up happening is that, in the last 1 to 2 years, a lot of businesses that we see that we're taking to market or that, or we're talking to as potential prospects, obviously the earnings look a lot better, right? And there's been this ramp up in earnings. And so obviously sellers feel more inclined to take a business to market when their historical earnings are better and their last year of profit is the highest they've ever seen because, well, I don't know how long it's going to last. And that's kind of that mentality when you're trying to exit a business. But from a buyer's perspective, you have to recognize that a buyer's not going to buy your business off of your last year earnings. They're going to pay a sustainable EBITDA benchmark looking back over 3 to 4 years to determine what is kind of that benchmark. What, if you've historically done $1 million in profit and this last year you jumped up to 1.5, are you really a 1.5 business or are you 1 and then some conditions result in you making a little bit more this year? And therefore they should be thinking of this as a $1 million business only. So, when you're thinking about pricing, you really need to understand and justify what is sustainable. Because, for most buyers, unless you're willing to provide, as I said, and I go back to here, if you're willing to provide an earnout to share the risk and say, no, I want to get paid off the 1.5 million EBITDA and I'll hold back an earnout for a portion of the purchase price subject to me maintaining 1.5 million in EBITDA, then you can get that value. Absolutely. But if you wanted cash and you're trying to sell off 1.5, you're going to have a lot of difficulty because buyers are not going to believe you. And obviously, you're not sharing that risk of maybe the business not delivering that again in the future. So, with COVID and everything we've seen in the last few years, that global supply chain conditions have influenced that. And so things are changing. They're always changing. Even if you're watching this video 10 years down the line, there's going to be something going on in the world that's going to influence, one time or over a permanent basis, the performance of a business. And you really need to distinguish what's sustainable and what's not and be honest with yourselves. And then, I'll give you an opposite example, something a little bit more permanent. Typically, if it's a external market influence like COVID, that's resulted in, you being able to charge more or having the supply that others don't, that's more of a temporary, one time situation. But if you changed your approach internally, you've hired management, you've implemented an ERP system, you're tracking pricing, raising pricing, doing things that are organic and in-house and within your own house, those are seen as more permanent changes to the value of your business. And so it's more justifiable to say, hey, in the last year I've hired professional management and changed X, Y, and Z. All of a sudden, buyers are going to be more believe that, that 1.5 million in earnings is much more sustainable. So that's why you have to kind of think of what's really influenced that and is it sustainable or not. And so, one kind of assumption I always try to explain to prospects is, really, I think this is going to last for 2 years. Maybe that's what they say. It's like, with COVID and everything, I think it will settle out for 2 years. But the next 2 years of EBITDA, I'm going to get 1.5. Okay, hold on a second. But if you want to sell your business, say, for example, for 4 times, the assumption is the reason I'm paying 4 times on your benchmark EBITDA is that I expect to get 4 years of that EBITDA. So if you think that your EBITDA is going to drop off after 2 years, is it really fair to price it off 1.5 at 4 times? Because realistically, the buyer is taking on more risk, and the buyer is smart enough to realize that. So you always need to think about sustainability. It really what you're trying to communicate to the marketplace is this 1 million in EBITDA is going to last for the next 4 years for sure. Or, if you continue to run the business the way it's being run today. So that's really kind of the assumption of sustainability versus kind of one-time gain. So let's look at an example. So this is a client that sold. It's a distribution business, give you kind of some rough parameters. And so, as you can see here, like over the last, pre-COVID, pre-2020, the business ramped up from 8 to 10. They were doing some nice changes. Kind of their margins were in that 23-24% range in terms of gross margin, and their EBITDA margin as well was kind of within that 1% range, 7.5 to 8.5% net. So very kind of, I would say, stable margin profile, profitability profile. Obviously, COVID hit. They were impacted by the shutdowns. And then coming out of that, they've recovered. And now they've come back to from the 10.5 in 2019 to 10.7 in 2022. So they're at pre-COVID levels. But the change, as you can see, is that the gross margin has increased significantly, from 24.5 to 31%. And the net profit has almost doubled from 7.5 or 8.5 up to 15%. So the question now is, I'm taking this business to market in 2022. What am I pricing this off of? Am I pricing this off of the 1.5 million EBITDA here with these higher gross margins? Or is it the historical gross margins that I should be thinking about? And naturally, most sellers always provide projections that are optimistic. And, I've never seen a seller's projections that were not, optimistic, right? So from a buyer's point of view, when you're thinking about valuation, you don't want to kind of get lost in what's happened in the last 1 or 2 years. You really want to understand why it happened. And then in this instance, the reasoning is that they buy a lot from the US. So I would say 80-90% of their purchases are denominated in USD, and 100% of their sales are based in Canadian dollars. And so throughout this time, the Canadian dollar strengthened, which allowed them to buy more cost effectively USD supply to stock it and then sell it. So there was a temporary, as you would say, kind of market influence FX gain on this margin. And in addition, post-COVID, they had a lot of supply in stock. And so they were able to raise their pricing and charge more for their customers because they had the supply that other competitors didn't. So when you think about those two things, are those sustainable? That's the negotiation when you're trying to sell a business like this. What's sustainable, what isn't? The pricing games, potentially some of those gains are going to stick, even if all of a sudden the supply chain normalizes and your competitors have the stock that they didn't before. But what about the FX? Is that going to change? Where is that going to go in the future? Right? So some of these things I would say are not sustainable, especially FX. And so when you look at that 31%, the question for you when you're really valuing a business correctly is it 24? Is it 31? Or is it something in the middle? And that's really up to your discretion and negotiation. And I would say, where this business landed, and, to show you kind of how the deal closed, in this situation, what the buyers did, and most of the market approached it this way, is that they took a multi-year average. So they took a 4-year average, 2018, 2019, they excluded COVID, 2021, and 2022. So these 4 years, they took the EBITDA performance of those 4 years, averaged it out, and that really gave them a $1.120 million target. And so then they applied a 5x multiple against that to get their purchase of 5.6. So that's how they valued the business from an EBITDA multiple perspective. And then from a structure perspective, to mitigate the risk further for them, because they are including these years in their average, which has brought their average up. And so their benchmark is higher than what it was in 2019. If you were to say, oh, no, this business is going to revert back to pre-COVID, well, the ultimate buyer didn't pay pre-COVID numbers. They still factored in an increase, but they didn't price it off 1.5. They priced it off 1.1. And so to mitigate some of their risk, what they did is they structured the deal differently. So they took 65% cash down, or 3.6. About 15% was a fixed guaranteed vendor note secured against the business for 3 years. And then there was a 20% earnout. So the remaining 20% was subject to the business delivering 1.1 million and above. And if they are able to deliver above 1.1 million, they could earn an additional 1.1 million in purchase price based on the excess performance above that 1.1. So if the business continues to only do 1.1, they will get the full purchase price. But if the business, say for example, reverts back to pre-COVID levels at 890,000, then that earnout would not be paid. And really, from the buyer's point of view, they only paid 4.4 million, the fixed purchase price, and that 20% gets lost. And the flip side is if the seller was telling the truth and their confidence was founded in realism, and they were able to deliver more than 1.1 and deliver kind of these numbers and projected 2023 at 1.7, then they'd have no issue in accepting that earnout. And so that's how the deal ultimately got negotiated here. So in this instance, when you're thinking about valuing a business, the way I think about it is A, sustainability, understanding the story behind the numbers, and then B, this valuation was influenced largely by the structure. If the seller was unwilling to accept an earnout, I would for sure not see a valuation this close. This client probably would have gotten something in the 4 millions, probably where the fixed purchase price was. But because they were willing to share in that risk and take that earnout, they were able to get a higher valuation for their business. So mistake number 2, so we talked about kind of the historical ramp up, but the opposite is, say, for example, a client is projecting future growth. And sometimes, there is real facts that confirm that a business is going to increase in the future, right? But, how do you really kind of price and value a business when you kind of have that hockey stick growth? And unfortunately, most buyers are pretty hesitant when it comes to kind of seeing those projections unless there's really concrete information that's supporting it. Signed contracts, confirmation from customers that they've made investments and that there's almost like a tied-in relationship that they're going to come back to the business. There's whatever the case is, there's got to be real concrete dollars or paper backing those projections. Because if it's really just the seller's assumption that the business is going to grow at this level because all of a sudden they've changed something, buyers are going to have a hard time buying into that. So really, the key thing here is finding the evidence to demonstrate that. But, if I was advising the buyer in this situation, I would also say, just in general, be careful with seller-provided projections because, most owners, if, they don't really have a really good budgeting process and sophisticated forecasting tools to allow them to think through projections, what ends up happening is they may give you a top-line number that is maybe reasonable in projection because they can easily say, oh, here's a $12 million contract over 3 years, and here's the production schedule. So I know what my revenues are going to be. but they're not sophisticated enough to estimate the cost structure and the changes in the SG&A associated with that ramp up in revenues. So if you are going to get projections from the seller, and I'm talking as a buyer, from the buyer point of view, I would really not dig into as much the revenues, because probably they have the supporting evidence for the revenues, but really dig into their assumptions on costs and how the cost structure changes. Because if I'm $1 million business now and I'm projecting to five, a percentage analysis is not going to do it. To say at $1 million, my SG&A was 28%, and it's going to be 28% at 5 million. That's not how it works. There's fixed costs that need to be added, and some are going to be variable costs. So maybe that percentage goes down. So really kind of digging into that's important. And most sellers don't have that level of sophistication to do it, unless their broker or their advisor really was able to prepare them. So in this scenario, when you're trying to price off future growth, typically there's a few ways seasoned buyers would value that business. The first is they just pay a lower multiple. Instead of paying 5 times for $2 million in EBITDA, they'd pay 3 times, factoring in the situation that most buyers are going to be turned off by this hockey stick growth. There's fewer buyers at the table, and therefore maybe they can get away with 3 times. The other is they structure a deal where there's cash down to allow the seller to realize some chips off the table today, but then they share the risk through an earnout. And if you deliver on those projected numbers, you get your money, but if not, you don't. And then some simply just will say, you know what, I'll pay whatever I can pay up front, but then I will pay a higher multiple and include a profit share for future growth for the seller. But you have to stay on to deliver it. So it's almost a sticky deal. I call it the sticky deal, where sellers have like a sales commission agreement instead of an earnout. And so if they stay and they help and they deliver on the growth projections while still working, then they'll get those sales commissions. But I always say, like, if you're going to stay, why sell the business? Just hold on to it, right? But anyway, so those are really kind of the 3 approaches. Really, from a sell side perspective, if you're the seller, ideally you would want to take, if you feel confident that those projections are going to hit, you just need to come to the realization that no buyer is going to pay you 5 times up front for those numbers. So you just need to share some of that risk. And if you do, and you're willing to share risk, there will be buyers that are willing to pay for those hockey stick type situations. So let's look at a real life example. So this is a service-based business, and very lean organization, kind of doing 1.6 to 1.85, in that kind of 300,000 EBITDA range. And so what ended up happening is that the owner, the seller, signed a few major contracts with past customers that they work with, and they all kind of happened at the same time. They came knocking on the door and saying, "We want to do this now. This is the right time to do it. We have the funds. The board signed off. Here's signed contracts." So from a sustainability and evidence perspective, there is good evidence to support that ramp up. And these were past customers that, are reputable. And so the question here, though, and this is what most buyers were asking, is, okay, great. So everyone kind of came in at once and booked these contracts, but these contracts were for 2 or 3 years maximum. What happens after the 3 years? If I'm going to pay you a 5 multiple, and we go back to that assumption of I want 5 years of those earnings if I'm going to pay you a 5 multiple. So how can you ensure that you're going to replace those contracts and find others to maintain that 1 or 857,000 in EBITDA that you're projecting? And that was really a key area of negotiation on this deal, because really it's selling on the replenishment and really the hunting part of the business, because this business was a little sleepy and the seller wasn't really actively pushing sales. So, really the message was, hey, listen, we got these contracts, funds are going to come into the business. We're going to hire salespeople so that we can build the infrastructure to start hunting and replenishing these contracts as they end in the next 2 to 3 years. And so ultimately the buyer that did buy this business really bought into that. They themselves had sales experience and thought that they could fill that funnel themselves. But, as I mentioned, really the way this deal got done is that the seller was willing to accept an earnout. And so they took a little bit of cash down. On top, they took an earnout. And so here, what the buyer did is they essentially said, you know what, I'll kind of take a multi-year average, which it came out to about 280,000 kind of benchmark EBITDA for the current business. And so they actually paid more for the current business. So for a business at 280,000, it may trade for 3 to 4 times, but the buyer ultimately paid a 5 times multiple for the upfront value of the business. So the seller got 1.4 upfront, but then they were also willing to share in that risk. And so really the buyer said, I think, with these contracts, you may be able to deliver 900,000 in EBITDA over the next 2 years. And so I will pay you a 5 multiple on 900,000, which could bring the deal up to 4.5 million. But I'm only going to pay you 1.2 right now, hold back a little bit of 200,000 for some working capital. And then the remaining 3.1, so the difference between the kind of the 1.4 and the 4.5, which is 3.1 million, that was the earnout that was held over 3 years. And so it would be paid out progressively over the coming 3 years if the business could demonstrate that it sustainably generated 900,000 over the next 3 years. And so anything above a certain gross margin threshold, 50% of that was paid against that earnout and could be earned. And so really it aligned the seller with the buyer a lot because the seller stayed on and was able to help in that transition, but also gave comfort to the buyer that, hey, listen, worst case, if this business reverts back, I kind of maybe a little bit overpaid, but not too much. 200,000 in the grand scheme of things is nothing, but really I'm getting these major contracts. I'm going to be able to buy the ramp up, and I'm going to be able to structure a deal where I'm essentially buying what I think is a $900,000 business, $900,000 EBITDA business for 1.4 million down, actually $1.2 million down, which they borrowed from the bank probably $1 million. So they put in 200,000 of their own equity to get a $900,000 business in EBITDA. So, it worked for both parties, but again, it went back down to structure and how they priced that business. And so again, if the seller is unwilling to share in that, they would never have gotten that 5 times multiple on the upfront money. And as well, that earnout of 3.1 million is very significant. And so if the seller was unwilling to accept an earnout, they maybe would have gotten $1 million for this business, and no one would have given them really the value that they could have received for this business if they were to accept a more willing structure. And so mistake number 3 is now we're moving towards more the invisible costs. And I think this is an important one because most valuators, when they think about, pricing a business, if you go to a CBV, and I keep using CBVs as an example, but it could be anyone. It could be your banker, it could be your friend, whatever the case is. They're essentially looking at your financial statements. They may ask you some questions on what your annual salary is or discretionary expenses, and they'll normalize that. But then they won't really think about the other adjustments that come up for different specific deals, and it depends. So these invisible costs are not all relevant for all deals. It's more relevant for specific types of companies and situations. And so I'm going to be showing you 2 examples, but I can kind of group them into the invisible costs into probably 4 buckets. The first is the annual capital expenditures. So this is really for asset-intensive businesses. Say, for example, you have an equipment rental business, you have a heavy industrial manufacturing business where you have a large amortization depreciation expense on your financial statements, but also you have to spend every 1, 2, 3 years to replace equipment, invest in your facility, maintain your overall competitiveness in the marketplace. And so when you're pricing that, most people will add back depreciation to get EBITDA, but the reality is, if the business is on an ongoing basis making that capital investment, all of a sudden CAPEX is more seen as an operating expense because it's required. You have to invest to maintain competitive. And so really those types of businesses are not priced off EBITDA, but rather EBIT. So you actually take away depreciation amortization and almost use it as a figure, as an annual average of what you would expect to invest in terms of annual CAPEX. Or the other approach is you price it off EBITDA, but then you take the last 3 years of CAPEX, take an average of it, and then deduct EBITDA minus CAPEX to get your free cash flow. And that's how buyers would price those types of businesses. But again, when you're thinking about or you're talking in general terms, if you have an asset-intensive business and people are talking to you about EBITDA multiples, just be cognizant that most seasoned buyers are going to see, hey, hold on a second, you're spending a ton of money here every other year to maintain this business. The reality is you're capitalizing that cost, but that's truly an operating expense because you have to spend it. Okay. Now, the second invisible cost, I don't hear a lot of people talk about this, but it comes up a lot. And I would say more, people based organizations. So, and especially it's relevant for when you're trying to sell to a competitor. So say for example, you're a consulting company, or I'll use a good example. You're an architectural firm, okay? And you have essentially you're selling your staff's time. And so your business model is essentially I have the cost of my staff, I'm marking them up and they're charging an hourly rate on all the jobs. And then, that's our business. That the profit I make is off the margin on my staff. But when you go to sell, people-based companies, from a strategic buyer's point of view, and this is less relevant for financial buyers because they're stepping into your shoes. But when a strategic buyer that's in your space is absorbing your staff into their infrastructure and their team, a key question is, well, how are you paying your staff? Are they above market, below market, or at market in terms of salaries? Because if I'm paying an identical junior staff member as the person that I'm buying, from you, and they're making $20,000 more, I have to adjust your staff's compensation to market level so that there's not an imbalance. Because if they're going to be working beside each other and one day, they share each other's salaries, or they find out that there's a gap, that those guys that just got bought are cheap and they're not making salaries, well, you're going to have an exodus of talent because the people that just got acquired are going to realize, hold on a second, I've been being paid below market. I can get a better salary elsewhere if you're not willing to give it to me. So in those types of below market salary adjustments, a real consideration is adjusting the cost of those employees to market when you're really calculating your adjusted EBITDA, because a buyer is already going to account for that if you go to sell it to a strategic buyer. Now, this may not be as relevant if it's a financial buyer who doesn't have other staff to compare against and they're buying just your business as the platform investment. So again, just be careful of how you approach adjustments. But for sure, if you're selling your business to a strategic competitor, they'll be asking that question. Now, the third bullet point here is very relevant in 2022 and 2023 because this is really in a rising interest rate environment. EBITDA always accounts for the cost of long-term debt, which is you're adding back the interest expense on long-term debt. But short-term financing like operating lines, vehicle loans, equipment leases, things that are seen as operating costs, that still have that are influenced by interest rates. Well, all of a sudden, as interest rates are rising, your working capital line and the interest on that working capital line will continue to go up. But now, when you go to market and say, for example, your operating line in the current marketplace is at prime plus 1.5% and prime is 6%. Well, hold on a second. You're paying 7.5% on your operating line and you've drawn $2 million on it, and you had $2 million drawn on your operating line 2 years ago in a similar situation. Well, the previous years where interest rates were at 3% or 4% and are now at 7.5%, I have to adjust the cost of your historical operating lines to market to really reflect what is the true sustainable EBITDA in the current marketplace. So that's really something that I'm starting to see from a lot of buyers that are intuitive enough to say, hold on a second, working capital or operating type financing is required for this type of business. And it could be, an HVAC company, right, where you finance your vehicles. You go to Mercedes and you finance your fleet. Well, all of a sudden, when you go to Mercedes and add another vehicle, instead of Mercedes giving it to you at 4%, they're giving it to you at 7%. And so on an $80,000 vehicle, if you're buying 5 of those vehicles, that 3% delta adds up. And so that's really a true permanent cost increase in the current environment that buyers are going to be accounting for, that you need to account for. So always not only add back your long-term debt costs, but also adjust your short-term financing costs to reflect the current ongoing financing environment. And now a seller may say, hold on a second, rates are going to come down. But the reality is a buyer, when they're going to lock in their rates to finance a deal, they're locking it in at the current rate because their financing is going to be booked at this level of financing. So they're not going to be as accepting of you to say, well, it may come down in the future because they're buying the current business in the current marketplace. If it does, it does, and maybe you can negotiate an earnout or a holdback if the conditions improve. But the reality is buyers are going to be factoring because it is a real permanent cost increase in the current environment. And then the last bullet point I've seen in some situations is, you're selling a business where in the last 2 years there's been profitability, but in the last 10 years, 8 years of that was losses. And so they have tax loss carry forwards. And these types of situations, I would say most buyers are not willing to really fairly price the value of that tax loss carry forward. But in certain buyers are willing to at least give a certain net present value. And so it's really kind of taking the next, the bucket of tax losses, saying, applying a discount rate and discounting it to a net present value, and then giving a certain percentage against that. And I would say in most instances, it may be 10 or 25%. I've never seen it be 100% where they're giving you full value for your tax savings, because why would they? And even at 50%, it's very, very rare. It would have to be a very competitive process. So I would say a real good kind of target is probably a quarter of the net present value is given to the seller, and then the buyer reaps the reward of the other 75% in terms of the future ongoing performance. Because again, really, those tax loss carry forwards are not recurring savings to taxes payable. They're really one-time savings that you're going to apply to future profit. So really the question is, how much do you get and how much do I get to keep that I can use for my own benefit? And so that's why I would say that 75-25 split between buyer and seller is probably what I'm seeing in the marketplace today. But let's talk about, two case studies. One is more on the market adjustment bullet point, which is number 2. And then on the right-hand side is the bullet number 1, which is the ongoing annual CAPEX. So here, this was a consulting company, you just closed this business, pretty recently. And so, we sold it to a competitor. It was very small, it was highly specialized, and there was not going to be any financial buyers that were seriously going to look at it. It was going to be a strategic buyer type sale. And so right up front, we kind of asked them, well, hold on a second. You essentially have 4 billable client facing staff. They have 20 years of experience. They've been with you for, over 10 plus years. They're really, really good staff that if they were to go into the open market, would generate a lot of demand from other employers. So what are you paying them at? And they were well below market. I would say kind of 20% was just an average across the 4 of them. So they were below market. And so when the seller was talking about his EBITDA, he was talking about kind of a $585,000 EBITDA. But we right away addressed the challenge, which was, this is going to be a strategic buyer that's going to buy our business. They're going to see those 4 staff. They're going to want them, obviously, because they're primarily the driver of this business. But they're going to adjust that salary, whether it's immediately or within a 1 to 2 year transition time. They will have to raise those salaries to retain that staff. So that really is not, that's a cost that we need to factor in up front in your valuation to fairly factor that in. And so we adjusted, essentially, we took the payroll, the staff salaries that they were currently in the financial statement. So it was about $390,000 in the last year of earnings, and we adjusted it by 20% upwards. So we adjusted up to $468,000, and that naturally reduced the adjusted EBITDA. So the market salary adjusted EBITDA level was actually 506 instead of 585, and that's really what we priced the business off of. And obviously the strategic buyers were very aligned in that, and we acknowledged that right up front, and they were actually very impressed by that. They actually said, "Wow, okay, that's good," because we get into that during due diligence, and sellers are resistant to accept that and all that. So we were very reasonable in our approach, and buyers appreciated that, and we got a deal done much quicker than we would have done if we resisted that and tried to negotiate it, because it would have come out in the wash anyways during due diligence when they would be looking at the employee agreements and say, hold on a second, this is a senior project manager that is getting paid $30,000 less than what we would pay an equivalent person at our firm, right? So it would eventually have been found out. Now, the other deal that we did was an equipment rental business. And so they were renting out heavy equipment to construction, mining clients, very, very nice business, repeat clients. But in the equipment rental business, the whole business is I'm buying capital assets and then I'm renting them out, to other customers who don't want to invest, $5 million up front to buy a fleet when they can just rent it on an as-needed basis. And so the margins are nice. It was a $17 million kind of sales business, kind of 20+% EBITDA margins. So, we're coming in at about $4 million in EBITDA. And so, most people were saying, well, this is a $4 million EBITDA business times a multiple of 5, but we obviously were, kind of immediately zeroed in on the hurdle for this deal, which was, okay, let's look at the last 3 years of EBITDA of CAPEX, just for example's sake. What is it? Well, they spent 1.75 million, 850,000, and 1.1 million because every 3 years, and this is the question I ask for equipment rental companies, is how often do you churn your fleet? Asset that's on your books. Well, if you hold it for 3 years, then, look back for 3 years and say, okay, on that churn cycle, the asset that you bought in 2020, you're going to dump in 2022. So, that this is really a good representation of the asset churn. And so, whatever that average over those 3 years is probably really just the true operating costs to maintain a modern fleet to replace what you currently have. And maybe there's some growth CAPEX in there, but conservatively, let's just say it's all replacement CAPEX for the current business. Well, in this instance, it was 1.25 million. And so we essentially said your EBITDA of 4 minus that 1.25 million gives you that 2.8 million in EBITDA. And that's what we priced the business off of. So we got a 5 multiple on 2.8. It would have been impossible to have gotten a 5 multiple on 4 because any strategic or financial buyer would say, hold on a second. So who's financing this capital cost? Because now all of a sudden, if I expect to get $4 million in my pocket in terms of cash flow to me as investors, well, that's not true because every 3 years I'm going to have to cut a check for probably $3+ million. So that's why factoring in CAPEX, especially when it's recurring, it's really just a true cost. And sometimes people just don't include that in there. So those are the first 3 mistakes that I see with private company valuation. And again, these are really relevant in terms of real world. Those are real world examples for you guys to kind of mull over. But in the part 2 video, I'm now going to be moving away from kind of the sustainable EBITDA questions and mistakes more towards the balance sheet related mistakes that I see. And these are more relevant for, situations where companies are growing or, they're steady, but markets are changing and they have to buy more stock and stock up on inventory, or their AR is extending for a certain reason. So, net working capital is a big driver of valuation because when you think about enterprise value and what a seller gets in their pocket, it's the value of that EBITDA times a multiple, and then plus or minus adjustments to the balance sheet value. And so you may have excess value, which would drive your enterprise value up, or the balance sheet may be running at a deficit and you're lean on net working capital, and any buyer is going to spot that when you go to market. So you may have to actually cut back a check to the buyer to fund that deficit, which would lower your exit multiple and your exit value. So that's why when you're thinking about pricing and valuing your business, it's not only just the EBITDA multiple, but it's also how the balance sheet is relative to that EBITDA. And so that's what we'll really get into with these next 4 mistakes. So hopefully you liked the video. If you found it helpful, please do like and subscribe to the channel for more, because I'm going to be trying to make more of these real life case study videos. If you yourself are trying to value your business and you want some advice or some help, you can obviously reach out to me over LinkedIn, through, the Rob Lee Capital website, or, just, at the below in the comment section. And, if you have any kind of other friends that would benefit from this video, hopefully you can share it with them so that we can kind of spread the positive word here. So appreciate your time, and stay tuned for part 2. It should be posted by the time you guys are looking at this one. So have a great day, guys. Thanks.